Have you ever found yourself questioning the real purpose of credit cards? Maybe you've recently asked, what exactly is a credit card? Well, you're not alone. Today we're going to break down the basics so that you have a better idea of what a credit card is. Hey everyone, this is Basically Finance, and today we're going to explore the world of credit cards and how they impact your credit score. Let's start by understanding what credit cards are and why they are an important tool for building and managing your credit. Credit cards have become an integral part of our financial landscape, offering a convenient way to make purchases and manage our finances. But what exactly are credit cards, and why are they such an important tool for building and managing your credit? In essence, a credit card is a financial instrument that allows you to borrow money from a financial institution up to a predetermined credit limit. Unlike debit cards that draw directly from your bank account, credit cards provide a short-term loan, giving you the flexibility to make purchases and pay them off over time. Beyond just being a plastic card in your wallet, credit cards serve as a powerful tool for establishing and improving your credit history. Your credit history, in turn, plays a crucial role in determining your credit score, a numeric representation of your creditworthiness. By responsibly using a credit card, you can demonstrate to lenders that you are a reliable borrower, which can positively impact your credit score. This, in turn, opens doors to favorable interest rates on loans, better terms for financial products, and increased financial opportunities. So, as we dig deeper into this realm of credit cards, keep in mind that they are not just about making transactions. They're a key player in shaping your financial future. Your credit score is influenced by several factors, and credit cards play a crucial role in shaping these elements. These categories are weighted differently and all help make up your credit score. We will take a closer look at what those categories are and discuss how credit cards play a crucial role in these factors. First, let's take a look at the first puzzle piece, payment history. If your credit score were a story, this would be the plotline. Your payment history is, without a doubt, the most critical factor in determining your credit worthiness, making up a solid 35%. It's a record of how reliably you meet your financial obligations, and the credit cards are front and center in this narrative. Timely payments on your credit cards can be a game changer for your credit score. Each month, when you make at least the minimum payment on time, you're not just settling a bill, you're building a positive payment history. This reliably sends a strong signal to credit bureaus and potential lenders that you are a responsible borrower. On the flip side, missed payments or late payments can have a negative effect. They not only incur fees and interest, but also tarnish your payment history. Many experts recommend you to pay off your statement balance in full to avoid any negative outcomes. All right, let's shift our focus to another crucial piece of the credit score puzzle, credit utilization. This isn't just a fancy term. It's a significant factor that can influence your creditworthiness, making up 30% of your credit score. So what exactly is credit utilization, and how does it impact your financial standing? Credit utilization is the ratio of your credit card balances to your credit limits. In simpler terms, it's a measure of how much of your available credit you're currently using. This ratio is closely monitored by credit bureaus and plays a substantial role in determining your credit score. For example, if you have a credit card with $1,000 in available credit and you use $100, your credit utilization would be 10%. Now, the impact of credit utilization is straightforward. The lower, the better. Maintaining a low credit utilization ratio signals to creditors that you're not overly reliant on credit and can manage your finances responsibly. On the flip side, a high credit utilization ratio may be perceived as a red flag, suggesting potential financial strain. Now, let's dive into the third piece of the credit score puzzle, the length of your credit history, making up 15% of your credit score. Time, as they say, can be a powerful ally when it comes to your creditworthiness. How long you've been actively using credit, and more specifically, holding onto your credit cards, plays a significant role in shaping this aspect of your credit score. The length of your credit history is essentially a timeline that showcases your experiences with credit accounts over the years. The idea here is that the longer you've responsibly managed credit, the more trustworthy you appear to creditors. It's a testament to your financial stability and ability to navigate the ups and downs of borrowing. Now, Credit cards are a key player in this narrative. If you've had a credit card for an extended period of time and have been using it responsibly, it contributes positively to the length of your credit history. This longevity sends a positive signal to credit bureaus and potential lenders, indicating that you have a proven track record of managing credit over time. Let's turn our attention to the fourth category that shapes your credit score: the types of credit in use, or credit mix, making up 10% of your overall credit score. It's not just about having one type of credit. Diversity is key. This category considers the various forms of credit you're managing, and yes, credit cards are an essential part of this mix. Diversifying your credit portfolio involves having a mix of different types of credit accounts, such as credit cards, installment loans, and mortgages. The rationale behind this is to provide a more comprehensive view of your ability to manage different financial responsibilities. Credit cards, being a revolving form of credit, contribute a unique dynamic to this mix. They offer flexibility in managing short-term expenses and can be a valuable tool when used responsibly. Understand that the importance of diversification is crucial for maintaining a well-rounded financial profile. Let's wrap up our exploration of the factors influencing your credit score by looking at the fifth category: new credit, making up 10% of your credit score. It might seem counterintuitive, but opening new credit accounts, including credit cards, can have a notable impact on your credit score. The goal is to manage new credit responsibly in order to minimize any potential negative effects. When you open a new credit card, it initiates what's known as a hard inquiry on your credit report. These inquiries are recorded and can have a short-term impact on your credit score. The rationale behind this is that multiple new credit applications within a short time frame might signal financial strain or an increased risk of default. However, don't let this deter you from exploring new credit opportunities. When managed wisely, opening new credit accounts, including credit cards, can contribute positively to your credit mix and overall financial health. That concludes our exploration of credit cards and how they impact the categories that make up your credit score. Remember to use credit cards wisely so that you are well off in the future. Thanks for tuning in, and we hope you return for more of Basically Finance.